Alright, so we see here that we ended up risking about $1.50, or no, actually just 71.37, maybe 20 cents. But from where I got in, it was more like 50 cents to $1 for 4.5, so it's a good 1 to 4 risk to reward, which is very solid. That is 100% what we want every time. And so one thing that I wanted to point out that some of you might not know is that this is just my account on TD Ameritrade, but I actually trade on Tastyworks, and I'm gonna show how I'm gonna go through a couple trades live tomorrow, and I'm gonna show you how I find these setups and what I do once I find them. And I'll go through my process because I can't show it on the screen. I'm just gonna talk about how I watch the volume profile and kind of scan for either accumulation, distribution, just to figure out if those support levels are going to hold, because a lot of times, most of the time I'm going to say, it's never exact, and timing is very difficult, which is why scaling in is very, very important. And so if I was looking at this trade, in retrospect, trying to explain exactly what I did and why I did it. So what I actually did, which I'll show live next time so that you guys can completely see it in action, but I always forget to do that, dang it. But I try and buy on a resistance and a support level that is clear, and then when it comes down for a retest, or when it already has made the retest and then it's coming down a second time, this is where it's either going to be a big break or make. So I like that third touch move. But a lot of times what you'll see is you'll see a huge spike throw down, and it'll just go right through, and then it'll shoot right back up. And so that's one reason why buying on support and selling on resistance is, see, because like right here, if you're selling or if you're buying and you bought right there when it shows up just above that high, you're going to be down for a long time until it makes it back up here. So that's all the importance of buying cheap and selling expensive. And I'm going to go over a couple examples live of my next setups that I find, and hopefully you guys can get a better understanding of exactly how I scale in and how I use this information, and pretty much find setups in general, because here I really wasn't thinking calls at all. That's one thing that I really like about the setup that I have, is that I'm not constrained to buying calls or puts, or if I'm bearish on one stock like I am on Tesla, I might quick scalp a call for a couple $100, you know. It's all just risk reward and managing that strategy, because if you know that this probability is when you get here you have a 1 to 4 risk, or if you took this trade 100 times, your expected outcome would be like net positive couple $1,000, where every time you took this trade you'd make money in the long run. That is exactly what I'm looking for. So essentially, risk to reward must be there, is number one. And then once you see that risk reward coming, you have to have a trigger. So my trigger was, alright, it's coming down to previous support. This is going to give myself an opportunity for the risk to reward. That is very profitable. And then execution and planning. So I know I don't have it up on the screen, but I have a little notepad, and I wrote out exactly the prices here and here, and then I quick drew them out, and I planned everything, but I didn't plan the target, but I knew I wanted the previous high of this consolidation because I knew it was a wedge, and if this bottom holds, there's no doubt it's going to make at least halfway back up, which is why I picked that support and resistance level right there. And the more that you see these types of setups, the more that you'll realize that there's only a few opportunities every day. If you're trading one stock, for example, you're going to get 3 or 4 opportunities every day for a very solid risk to reward ratio. And then the goal is to get some sort of edge. So for me, my edge right now is understanding accumulation, distribution, and what everyone else is doing in the market. So if I see a lot of shares being accumulated every time the shares drop below 600 or 762, you'd be like, all right, that's a support level, and I'm going to see when is it going to pull back for me to get an opportunity to get in on this swing because they are pushing up. On the other hand, like yesterday here in the morning, I didn't record any videos, but the volume profile was telling the whole story. And then the tape, time and sales, I was seeing huge selling coming in. Absolutely everyone was distributing. It was breaking out, quote unquote, because it gapped up overnight. But within the first 15 minutes, when you see it spike up like that, and it did not last very long, that is like my number one trade right there. That is the most fading a gap up like this. Let me put it in perspective real quick. So a gap up breakout happens maybe 1 out of 100 times, and yeah, you might be able to make like 1,000 times what you risk to reward, but the trade might only work 1 out of 100 times. So in the end, you're gonna fail over and 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 over, and you're gonna be like, and then you're gonna eventually just not take the risk when you actually need to. And this type of trade is the exact opposite. It'll work 99 times out of 100 if you understand risk to reward properly. So once it got up to this level early in the morning, I saw huge distribution. So these big levels on the volume profile near 800, I saw it at 800 mostly, but the 800 level and the 810 was not really telling a whole lot, but the 800 and levels lower where people had previously bought, which was, there's huge accumulation at 750 and 760, which was from the previous days. And they all unloaded once it broke above that. But all they needed was a few buyers to push the price up to give someone to sell to. So if you think about it in terms where you have to think like if I had, for example, 200,000 shares of Tesla, what price would I even be able to get those shares out at a profit? You know what I mean? Because if you just look at on time and sales, for example, if you just sold 200,000, you're not going to get a very good price. See, look, even if you only buy 400, you're paying more or less from the bid and the ask. And that's exactly what I'm talking about. So imagine this times like 10,000 or 1,000. You're going to have to accept all these bids or all these asks. No, and yeah, if you're selling, you have to accept all these asks. And you're going to end up just getting horrible prices, which is why they have to wait for an opportunity when buyers are really stepping in so they can exchange hands. Now that you understand that concept real quick, the fade that I'm talking about, the reason it is such a high probability is because once you see these huge volume distribution happening, but a lot of times if like it's actually trading, say at 790, all of the distribution you're not going to be able to see because it's happening all the way down here. So what I like to do is I like to keep this entire thing up and then make a list of the really big numbers. So every couple minutes, if I see a huge spike up or down, every 5 minutes I like to check it. So this is, for example, this price is probably 274 flat. Yeah, and previously there was 177,000, and now it's at 205. And look at, so everyone, so there's someone here that is accumulating shares or frequently trading them at 207 or 774. They're buying, and so when it drops below there, they're at a loss. So you have to think, well, are all of those people going to sell, or are more buyers going to step in? And what you can see frequently is that a lot of buyers tend to step in unless it's a major downtrend, which is where like once they start to step in, they really just keep going. And so once you can understand a couple concepts like this and just kind of keep tabs on them, you can really see when the accumulation and distribution is happening from the bigger traders who have like 200,000 shares that can force the price to move $20, $30. And so that's really, in a way, like my double-edged sword, because I like to buy on support and sell on resistance. But the confirmation in my system is used through the volume profile of the tape, and which, if I don't see it, I don't take the trade. But most importantly, like this trade is shooting up, even though I probably got out here earlier, and people are like, oh, it's shooting up now, it's finally breaking that higher high. There's traders that are buying this right here, no doubt. I'll never take that trade. If anything, I'll look to short it at this level. Why? Because it's a higher probability. From this high to this high, from this high over and over, like I might risk that high and short it there. But the thing is, I'm not going to just take that blindly. What I'm going to do is I'm going to wait for some sort of confirmation that the buying is done there. And I'll go back and check my levels, and I'll say, hey, have people started to buy or people started to sell? And that's when I'll really just start to figure out. Because here, like just for example, like if I'm risking $2, $7.80 to $7.78 for $7.72, that's 2 to 6, so that's 1 to 3. So I'm still have a good decent risk to reward ratio, but you still have to think, well, I've got commissions and spread, so that's why you need to be right more than 60-70% of the time, so that when you do take those big risks, you can say I get in one contract here, and then I might get in another contract if it pops up again here. Just that way, I like to reduce my risk and average down. Some people will really say it's the stupidest thing you can do, but I only buy on pullbacks, and I'll try and get in. If I am confident that is the top, then I'll just try and get 2 contracts there and keep a smaller stop loss. I really don't like buying on a trend continuation. I'll almost always wait for a pullback, and the more that you trade, you'll realize that you will never buy or sell on a top. Like I won't buy here because that could be a potential top, but it's not going to be a potential bottom. You know what I mean? So as long as you always buy in the right place, or let me rephrase it, at a good price, you always have a decent risk to reward or opportunity for profit. Because if you're not giving yourself the proper risk to reward, you're just setting yourself up for failure. And until you actually like compute these numbers and do the math, you're like, all right, after commissions, after spread, after this risk, I might be down plus theta. So since I'm trading options, from here to here, 15 minutes, if my theta is like 3,000, I might be down like $300, even though it might not have moved at that point. But since I'm trading options, a lot of times I only want scalps with a really high risk to rewards, and that's it. And consistency is the only way to be profitable. If you're not consistent and you don't have a game plan, there's no way you're going to make money. That's just the facts. Less than 3% of really good traders actually make money. Everyone else just gets back to profits because they are not patient enough and they don't take proper risk to reward trades. So if you need me to explain something else and exactly why I take the trades that I do or how I find them, I'm going to make a couple videos next week of me doing a few live trades. Once I get some stuff done, I'll have a little bit more free time. But I'm going to really show you how I find the trades and how I confirm that I'm right. But more importantly, I confirm the risk to rewards and that my system works. I don't care if I'm wrong. If I'm wrong, I get out of the trade. You know, you have to obey your stop losses, or else you're going to take one big loss and be done, and you're never going to have enough capital to stay in the game. So if you got any questions, let me know, and I'm going to try to make a live trade later this week. A couple live trades, actually.